We're excited about it. So again, my favorite topic, real estate, always incredible. Kevin's a lot of fun. We love having him on. Thanks everybody for being here. So again, the topic is evaluating real estate markets for your investments. Like the sunshine here is coming in through that window here. But with Kevin Clayson with Done For You Real Estate, we've known Kevin for a lot of years. I'm going to get to a little intro of Kevin, but before I do, I want to go through, just our upcoming schedule here. So as you know, a lot of you, we have a great schedule this summer. Next week, Clint Coons, asset protection attorney, anonymity. This is going to be an interesting one. So for you real estate investors on the call, this is a big one, especially if you don't want your tenants knowing who's owning the asset. This is important. So jump on that one if you can. Some other great topics coming up this summer. We're excited about it. And as usual, so right now what we're doing is a lot of you we see can't actually make. We have a lot of registrations and some of you can't actually attend the webinar. So as long as you register for the webinar, we then have a YouTube channel. So it's youtube.com/Protect Wealth Academy. And that's our channel. So just do that. And you can see there, YouTube, Protect Wealth Academy, boom, boom, jump on in and subscribe. And if you subscribe and then get notifications anytime we put a video, so if you watch this and you want to see Kevin on a video later, at least for 30 days. So they do stay up for 30 days. Sometimes we put them on longer, sometimes not, but at least 30 days. It will be up there and you can watch it if you missed it. So Kevin's always good to watch too. And I can just rewatch it. It's great, Kevin. So I'm excited. Thanks for that. All right. So also coming up in Orlando. So our first foray back post-COVID life, at least we hope right now, coming up Orlando, September 16th, 17th, and 18th. Now this is going to be, wait a minute, those dates, I'm checking those dates. I think those dates are I'm double checking because I think that's not what I have. Last time we had some issues where this date kind of redid itself on here. I'm just double checking to make sure I give you the right dates. It's a Monday, Tuesday, Wednesday, and this will be at the Omni Champions Gate in Champions Gate, Florida. And let's make sure I did that right for everybody. All right. Well, sorry about that. 13th to the 15th. I knew it. All right. 13th to 15th, guys. Those dates are wrong. So September 13th, 14th, and 15th in Orlando at the Omni Champions Gate. So this is a beautiful hotel. If you guys are coming, 13th, 14th, 15th, 5-star Diamond Hotel. This is a beautiful resort, and it will expire August 16th. The room block. So if you haven't booked, I suggest booking soon. They are selling out. So what they're telling us is, even with the Delta variant and everything else with COVID, they're still selling out right now. Everyone wants to get back out. This is on a golf course. You can see the pictures there in the background. It's a beautiful pool, lazy river, and they've given us a room discount and a resort fee discount cut in half. So every deal we have on here is actually really, really good. If you haven't booked your room, do it because it's till August 16th or when they fill up. And last we checked yesterday, they were about 80% full. So on our block, which means it'll go fast. Okay, so check it out, protectwealth.com. If you have questions, give us a call. And then don't forget lunch with Don. We don't actually do lunch. We actually have water with Don, it seems like most days, because we forget to bring in lunch. But Don does a Q&A session here. It's fantastic. If you have asset protection or tax questions, it's a Facebook Live with an archive on Facebook. So if you can, jump in, it's great. And we always do a legal disclaimer. So asset protection tax strategies, this is not specific legal advice. This is, or investment advice in this case, right? So if you're looking for specific legal or investment advice, seek a competent professional for you because this is to an audience, right? It's not for you. So, all right, let's get to Kevin. Kevin, thank you so much for being here. Evaluating real estate markets for your investments. So a very, very good topic. I think a very timely topic. Most people are curious. I think most people need to evaluate their investments right now, Kevin, because everyone's afraid, oh, it's a bubble. It's going to go anytime now. It's so hot. I don't know. I've been saying that for years, and I'm glad I didn't wait and say, oh, gosh, I wish I would have got in because I wish I'd have bought more for sure. So you know all about that, Kevin. I'll turn it over to you, and then maybe we'll do a little bit of Q&A at the end. Are you okay with that?
Yeah, that'd be great, man. Awesome. I appreciate it, Kendall, and super excited to be with you guys. And I am proudly not a competent professional, so don't seek my advice.
Whatever.
I
You are
will
the
share,
most competent.
but I will share some thoughts and ideas with you guys that I hope will be really helpful. Real estate is we get that question a lot. I'm on the phone every single day with clients and they're wondering, is the bubble about to pop? Is it going to pop? What's going to happen? And I'm going to share my screen just so we've got that up there. Hold on one second, just so let me get that going.
And that's not true. And Kevin, maybe you want to introduce yourself a little bit to some of the new people, but you are, the thing I will say about Kevin and Done For You Real Estate, you'll probably introduce a little bit. They're the most transparent I've ever seen by far. I love that fact about you guys. So totally probably the most competent that I've seen as far as transparency.
Well, I appreciate that very, very much. I want to put the right screen up here. We've been at this. Which screen are you seeing right now? Are you seeing my family?
No, I am seeing play. Good.
You're seeing a what?
Hit play. How to select? I think.
Oh, good. All right. So you are.
Yep.
Are you seeing the counter and stuff? Or are you seeing the actual?
I'm seeing the actual.
Okay.
The actual slide.
Awesome. So we've been at this for about 15 years, and I appreciate your kind words about my competency. Look, I do not consider myself a real estate expert, but we are expert at what we do. And the reason I say that is, you come to me and I'm not going to give you every real estate strategy under the sun. And we're not going to talk about wholesaling and flipping. And we're not going to talk about, a variety of real estate strategies. What we do, we are expert at, which is simple and conservative single family residential real estate. And just to give you an idea of what we've been able to accomplish, just to give you a little bit of background of us. So you can go check us out. We're an A+ accredited business on the Better Business Bureau. We've got hosts of 5-star reviews on Google. We are part of the Forbes Real Estate Council and we publish on Forbes. We've won multiple property awards. We have a top rated podcast with a bunch more 5-star reviews called Replace Your Income. We've transacted over $500 million in single family residential real estate with our clients. Our clients have purchased well over 4,000 homes. We've been in business casually since 2007 and officially since 2008. And we have helped our clients invest in multiple markets. We currently are helping our clients invest in 5, and I'm going to share those with you and why we've picked those and how to find a good market. Whether you work with us or not, I want you to know how we get there because we take a very scientific approach. Being in this for as long as we've been in this, we could tell you that that picking a real estate market should be a scientific process. It shouldn't just be a gut feel. And it's not just what's the purchase price, or it's not just what is the, what's the cash on cash return. These are important questions, but there's a lot more that goes to it. And thankfully, we've been able to do a bunch of real estate over the last 15 years, and we've been able to have some success with our clients. And just so you guys know, that's what's really important to us, is the success of our clients. Full disclosure, we do not charge anything up front. We only make our money on the transactions. We charge a flat per property fee, and that gets charged on the closing documents as a separate buyer paid commission. And that funds our ability to help our clients do everything. I'm not going to go in and do a pitch on our company. That's not what I'm here to do. I'm here to just add value. So let me just briefly tell you who we are and what we do. We're Done For You Real Estate. You can go to dfy-realestate.com and check us out. Our job is to make real estate investing as dead simple and easy as we can for people by doing the majority of the heavy lifting. We're not a traditional turnkey company. We don't go and buy properties, flip them to you. Instead, what we do is we've got teams in the field in multiple markets that we've selected based on the extremely arduous but super cool process that I'm going to share with you here tonight, really high level. I'm literally pulling the curtains back, you guys. This is sort of like if McDonald's gave you their recipe, right? That's kind of what I'm going to do. The reason why I'm willing to do it is because Kendall and Dawn asked that I would come and just share value. And that's all I want to do. We do not think that everybody's going to come and work with us. We know we're not a good fit for everybody. Who we're a good fit for is folks that are busy, that have assets, that want to utilize simple and conservative single family residential real estate, and that don't want to do that heavy lifting because they're busy. Somebody who wants to access markets that they don't live in and have 95% of the work done for them. That's what we do. And so I won't go into that too much tonight, but what I will share with you is the markets that we're in, why we're in those markets. And if you want to do a little bit more of a deep dive, you can, I'll go over that in a second. I have a slide at the end that'll give you a link to our website, dfy-realestate.com, and our podcast, Replace Your Income. You know, we got about 50 episodes on a page where our podcast is hosted. You can see the top listened to episodes, the first 5 episodes, which really establish a framework, and that's all there for you. Do with it what you will. So what I wanted to do tonight is I wanted to talk about how do we go and select markets. So as a company, why do we go to the markets we go to? Why do we take clients to these markets? It's a very scientific and mathematical approach that we're taking. And so I'm going to share that with you guys, and I hope that'll be good. Real quick, I want to just answer a question. There's a question in the Q&A from Sid, and he said, he's asking me, Kevin, how can I add value in terms of equity buildup while purchasing the asset? I hope that'll be answered tonight. Just really it boils down to going to the right market with as little work as possible for you. That allows you to access equity buildup and equity growth, but the market is different than you may think right now. So everybody's kind of heard that the real estate market's really hot. Is it a bubble? We get that question all the time. Look, there's always peaks and valleys. I don't really look at it as bubbles. It's kind of like peaks and valleys, but at the end of the day, what we find is that the real estate market starts here and ends here. It may go up and then crash and then come back and then crash and then come up, but it always it's kind of like a stock market. It always goes up. Here's how I can tell you that in real time and with as much real life experience as possible. My parents bought their home. I grew up in Oakland, California, just outside of Oakland. My parents bought their home in the Bay Area for like, what was it, about 40, I think around 40 grand. Like in 1964. And they sold that property for just under $1 million, okay, in 2019. So now if you think about what happened during that time frame, how many different administrations, how many different Congresses, how many different state assembly people in the state of California, how many economic booms and busts, how many different presidential policies were in place, wars, etc. Think of everything that happened from like 64 to like 2019. And during all of that, if you would have taken a cross section of any one of those moments in time, you could have said, now's a good time or now it's not a good time to buy. But if you would have bought when they bought and sold when they sold, you end up crushing it. That's the way we look at real estate. We want real estate to be a long-term investment. That's the way we view it. Everything I'm going to share with you tonight is based on that premise that this is not a get in and get out. This is not a flip. This is not a sticking to the 1% rule, because like I told you, the market is a little bit different right now. And so what I wanted to start with is just kind of helping you understand what is happening in the market right now. And this is born of experience. So I'm going to share with you just briefly the 5 unexpected, unconventional, and historically proven criteria of a purchase-worthy property. Now, I want you to notice the first thing right there. We're talking about a purchase-worthy property. So often, we love to look at real estate through the lens of, is it a good deal? Now, that's something that's kind of been bred into us. We hear it all the time. Is it a good deal? Is it a good deal? Well, I want to not ask, is it a good deal? I want to know if it's a purchase-worthy property. Is it worth purchasing? Because buying with equity, while at times in the economic curvature of the world that we live in, buying with equity is doable. Right now, it's very rare to buy with equity. Now, here's what I mean by that. If you buy a home at current market value, you're not going to buy it with a 20% discount or something like that. If you were to go buy a home with a 20% discount, with a 30% discount, it's likely discounted for a reason, which means you're still paying current market value, but you have to understand market value is what somebody's willing to pay for it. If you're buying a property in what you perceive as a 20 or 30% equity position, really your only equity is, can you fix it up quicker and better and cheaper than the other guy? That's your real equity, okay? Because you can buy the property for a discount, you could sell it for a discount, but it's really hard right now to buy a property for a discount, do nothing with it, and then sell it for a gain, okay? It's difficult to do right now, even though the market is increasing. So we love to look at it and say, is the purchase price current market value? Okay, that's what we want to know. By the way, that may be at or above or below asking price. The reality is inventory is very tight. You still have to move fast. There's a massive shortage. So if you are shopping for real estate right now and you're looking for a good deal, you're probably not going to win a piece of real estate, which means your good deal flies out the window. What's your opportunity cost of not buying real estate right now because you're hunting for a good deal? The question is it a purchase worthy property, which means, is it in the right market, which is the second thing I have up here, meaning, and this is what we're going to talk about tonight. Is it in the right economy? Is it landlord friendly? Are the tax and rental situations, are those favorable to the investment? Okay. Is it in the right neighborhood, which is not just going to attract the right tenant, but attract the right property manager? We do long-term or short-term buy and holds. Okay. Here's another one. Does the property deliver positive cash flow? That's something that we think is really critically important right now. There's a lot of companies and a lot of people out there that are saying just buy for equity. If we buy for equity, we're not taking into account some of the risk of if the market does dip temporarily, right? If we buy for equity, sure, it's going to go up over time. But if we're in it as a short play, then the equity equation maybe isn't the most important. We should be seeing if we cash flow. If we can have positive cash flow today, we've got a little margin of safety built in so that if the market does dip, if the market does go down, if rents even go down, we've got a positive cash flow, meaning are you collecting in rent more than what your principal, interest, tax, and insurance payment is? And if you could do that successfully, and we're going to talk about numbers tonight, you've got a little bit of a margin of safety built into the property. Critically important right now. There's a lot of people who'll go buy just with an equity play, and they may be in for a rude awakening if they're hoping this is going to be a quick turnaround. So all depends on strategy, depends on you. And this is the last thing that we see right now is really important. The property needs to have predictable and historically consistent performance. We believe in real estate singles, and that's why we know we're not everybody's cup of tea. There's a lot of people out there that want to go hit home runs, and I think that's great. We subscribe to Moneyball Philosophy. If you remember the movie by Brad Pitt, or with Brad Pitt and Jonah Hill about the Oakland Athletics, is based on a book by Michael Lewis, who wrote the book on The Big Short as well with the mortgage crisis. Moneyball was the Oakland Athletics back in the early 2000s, had a payroll of about 1/3 of the New York Yankees. And so the Oakland Athletics, Billy Beane, who was the general manager, had to figure out a way to field a team with the money he had and still put up W's, still make wins happen. Now, how do you do that if you can't really compete monetarily with a team like the Yankees? So what they did is they went, not found star players, not found home run hitters. They went and found players that could get on base, that could take a walk, that could bunt really well, that were really good at hitting singles, maybe that could steal some bases, people that could increase the on-base percentage and the slugging percentage. That's what they focused on. And as a result, they had the single season win record in Major League history. A bunch of people who you very maybe well not have wanted on your team. But they looked at it through a different lens and they won. Now, they didn't win the World Series, but they changed baseball forever. The way we look at real estate is we look at real estate through the lens of going and hitting real estate singles. Okay. We want to minimize the risk, maximize the return with a minimized risk so that we can mitigate some of the dangers that come with an inconsistent real estate market, right? It's consistent over the long run, but inside of any little clip of time, it may feel inconsistent. So we try to hedge that by being as conservative as we can. Okay. Now that I've shared that with you, let me show you what we think a real estate single is, and then this will shape the conversation for what we need to look at as we're going and looking for markets where you ought to be considering some real estate investments. We love to target between 11 and 18% annualized returns. If we combine the cash flow and the appreciation, we should see between 11 and 18% annualized over the time that you own the property. We are looking at properties that are priced between 180 and 280,000. We are not scraping the bottom of the barrel for these prices for these homes. You can make money on cheap real estate, but it's an entirely different ballgame. We want kind of blue chip real estate. Simple, conservative, solid performing real estate that has a track record, okay? So usually we find those homes are priced between 180 and 280. Not every market in the country will allow for that. So that's a big piece of what we're looking for. We want the target cash on cash to be between 4% and 8% taken monthly, just in terms of your net cash flow versus your overall output in order to get that property, okay? We're always doing single family residences. The average layout is a 3 or 4 bed, 2 bath, 2 car garage. That's what we look at. That's what we focus on. The neighborhoods we focus on, owner occupied, middle income, middle class, good job market in the greater area, good local economy, and mild weather, okay? This is what we see, meaning meaning of target cash on cash? That we just got this question. Meaning of target cash on cash is if you were to take a look at your overall net cash flow for the year, right? Let's say it's $10,000 in cash flow. And let's say you put out of your pocket, okay? You put out of your pocket $100,000 to get a property. Your cash on cash would be 10%. Now you take that monthly, right? You don't get that 10% all at once. That 10% or that $10,000 is spread out over the 12 months. So we look at total net income from your cash flow, and we divide that against a total out-of-pocket expense to get the property. That gives us a percentage that's taken every month in the way of that cash flow. So our targets are 4 to 8%. Okay, hopefully that helps and that makes sense. So there you go. Okay, awesome. Now let's move on and let's really kind of dive in here, you guys. I'm excited to share this with you. I hope that this will be really beneficial and really good information, and you can brag to your friends at the party and say, hey, I know lots of cool stuff because I learned about how to go find markets. I am looking for my cursor, you guys. Hold on, I may have to do this. Let me 1 second. There we go. All right, we got it.
That's where it's at.
Yeah, okay, there now. Thank you. Okay, I couldn't see it. All right. So what I'm going to share with you tonight is our 4-phased approach to going and researching and finding markets that can be really beneficial and really helpful. Okay. These are markets that are real estate single markets that are conservative, that are simple and conservative, that generate awesome returns, that generate great cash on cash. Okay. That's kind of what we're looking at. So the first thing I'm going to talk about is the research we do. The second phase is the comparison and analysis we utilize. The third phase is actually which markets we're in and which markets I think you ought to be considering as well. And then the fourth phase, I'll talk a little bit about how we set up our team on the ground to make the whole thing happen. Okay, so let's dive in. Phase 1. Okay. This is the process that we go through in the first phase so that we generally figure out which markets should we be drilling down on and doing additional research. Now, a couple things to notice here. We do a variety of Google searches. I've added some of them here for you, okay? 10 best places to buy rental property. 18 best places to buy rental property for cash flow. 8 best housing markets. 20 best cities to own investment properties. 15 best cities to buy rental properties. I mean, you guys can see it's a variation of things here, right? Zillow price to rent ratios, the top 20. 48 cities with net annual cash flow over 10,000. The top 100 safest cities in America. Now, not any one of these single searches is going to give us what we want. But what we do is and this is what, 10 searches? We do dozens and dozens of variations of searches like this. And what we find is a variety of articles. Now, you guys know, just like I know, you always have to be careful of who the source of the article is. What you'll find, you may Google search, and there's a lot of people out there that are really smart from an SEO standpoint, and they will write articles that serve their business that are not free of agenda. It's not journalism per se. It's somebody saying, I'm in these markets, so I'm going to tell you that these are the best markets to invest in because that's where I want to help you invest. So you've got to, it's always a good idea to see who the source of the blog post, see who the source of the article is, and to drill down on who they are and what their agenda is. Then you'll also find other articles that are being done by certain types of journals or certain types of reputable news sites. So what we do is a variety of searches, and from those searches, we always shake out anywhere from 10 to 15 markets that appear to possibly be markets that we really want to drill down on and look deeper. Now, one of the things for us is we are not trying to be in all of the markets at once. There's some, if you're interested in looking at lots and lots of markets at once, you ought to take a look at some of the companies, some of these venture capitalist backed software solution companies that give you listings like the MLS, but it's more of a private deal, or they're showing you aspects of the MLS, the multiple listing service in real estate. And you can look at all kinds of properties and they claim that it's turnkey and you could buy stuff from anywhere in the country. That's awesome. For me, that causes a Netflix paralysis. You guys know what I'm talking about with this. If you ever gone on Netflix and you're like, I'm going to watch something great, and then you spend a half hour trying to figure out the thing that you want to watch before you actually watch it. So now you've lost a half hour of watching time. If there's too many choices, to me, it's very difficult to make a choice, okay? And so what we try to do is we do these kinds of searches. We do this kind of information to be able to shake loose 10 or 15 that we can then drill down and figure out what are our top 1, 2, 3, 4, 5 markets where we want to help our clients invest, where we can go and set up boots on the ground so that we can help people really facilitate a positive investment experience, okay? In the spirit of simple and conservative real estate singles that we do and have done successfully for 15 years, okay? So after we do these searches, that's kind of phase one. From there, we'll shake out some markets. And this is where we really get into the methodology and the criteria for comparison and analysis of which markets we ought to be in. So my hope for you here is that I'm going to give you a bunch of ways that we look at real estate. I'm not saying that this is the only way to look at real estate. I'm saying this is our secret sauce. This is our recipe. Thankfully, the recipe has proven itself out over nearly 2 decades of massively successful investments for ourselves as individuals, as a company, and for our clients. It's not the only way. It's not even the best way. It's just a way that is successful. So full disclosure there, right? I am not so naive to tell you we're the only game in town and we're the best ever. No. Our focus is helping our clients create success. Plain and simple. How do we do that in the easiest, simplest way? And this is what we've kind of come up with, okay? So I hope that in sharing these criteria with you, I hope you'll take them, write them down, and utilize them to your benefit. I hope that it's really helpful for you and you're able to go crush it. So once we kind of shake out some of those markets, we now create the methodology and then go into the 35 criteria that we're really utilizing, okay? The methodology is this. We are ranking and we are scoring, okay? It's not simple or ordinal rankings of 1 to 10, but there's a lot of times there's these degrees of variation in the score that results in some skips in rankings. And there's also some types of score that we're going to weight differently. And so there's kind of I'm not going to go into the science of that because that would you guys would fall asleep. I want to get to the meat and potatoes and help you know. So there's a whole ranking process that we do and a scoring process that's kind of our secret sauce in addition to what we're actually looking at. And so from there, we're able to not just shake out the markets, but then we're able to score according to all this criteria. And then that's where we then do further research, look to get boots on the ground, and then start to do real estate, okay? That's the methodology. Here's the criteria. So I hope that you guys can see this, okay? I'm going to go over each of them. I'm not going to go into crazy depth on each, which is why I want you to write these down. You guys can take a look and do some more research on your own if you so desire. So the first thing we're looking at is something we call an investment score, okay? And here's kind of the definition of that. Expensive and exclusive governmental aggregated data source that we use, which gives an overall rating of risk based on 5 economic factors: population growth, job growth, unemployment, changes in home price, and whether the market is overpriced. So when we looked at our markets, we'll find that some of the scores are speculative, some of the scores are medium risk. It's rare, but there are some that say that they're low risk. But even with this government aggregated data source that we spend a lot of money to kind of have access to, we know that even within that, inside of zip codes, inside of neighborhoods, there can be variations and differences. And that's why we get to the boots on the ground to really do the in-market research. But we have an investment score, which is one of the first things that we're looking at. That investment score comes from aggregated government data and an award-winning data service. That's the first thing that we look at to help us shake out of these, 10 or 15 markets from our searches, which ones we really want to continue to drill down on. We also look at the ranking of economic function, okay? This is determined by considering retail sales, newspaper circulation, universities, hospitals, how many corporate headquarters, if there's, one of our markets, there's a massive FedEx, airport, frankly, and tons of people employed and headquartered at certain companies. So that's something that we're looking at. That means there's a positive economic function for that market. We also look at the best places to live, right? And that's, based on quality of schools and crime rates and things to do and where people want to live, okay? Those are some of the things that we look at. We also look at the median wage, okay? A couple other things we look at. We look at the 3-year wage growth in any given market. Why? Because the wage growth is an indicator of economic stability. And so we want to go, and part of the reason why we look at wage growth as well is we love to go and find markets that are going to see an anticipated rent increase year over year. Here's one of the things that we're finding right now, and some people Maybe you're considering this. I don't know how many are, but this is one of the things that we find. Home prices are going to continue to increase at a greater rate than rent. But that does not mean that you are not hedging inflation. Real estate hedges inflation when you look at all of the benefits that real estate gives you, right? When you look at the growth of the property as well as cash flow, remember, you're locked in on a finance deal or on a cash purchase. You're effectively locked in on your interest, and you're signing rental contracts that are about a year or more long, depending on the tenant. So you're still hedging from a certain extent, but you want to make sure that year over year, your rent can increase. If your rent doesn't increase year over year, people find themselves in trouble. They own all this equity. They have this property. They don't want to kick their tenant out. They're not making as much as they should. And they start to look at it and go, oh gosh, I mean, do I need to get out of this investment? So we like to look at wage growth, because wage growth is usually an indicator that we're going to see rental increase. Okay. That's just part of one of the things that we look at. Unemployment's big, right? Unemployment is going to indicate what incomes look like, which can largely, we want to go find neighborhoods and properties and homes that attract a high quality tenant and a high quality property manager. If we're in areas with massive unemployment, we may not be attracting all of the right tenants that we want to. Okay. We look at job growth. Job numbers are critically important. If we're seeing job growth, and in a lot of our markets, the job growth is outpacing the national job growth levels. Now, what does that tell us? That tells us, along with all this other criteria, we're in a healthy economic area, and we're in a market that, again, we're trying to hedge. Conservative, right? This is a science, but it's not an exact science because things change on the daily. So we have to look at large bits of data and draw conclusions from them. Okay. And by the way, Kendall, I am not watching the Q&A or the chat or the hand raises. So if at any point you need to pop in and say, hey, we've got a question, do so, because I'm just kind of boring ahead here with content. So fair enough. Will you let me know if there's something that I need to address?
For sure. No problem at all. Thank you. This is one question came in, was it U.S. market only, not Canada?
Mm-hmm.
Right?
Yeah. So we're a U.S. based company. We do U.S. investments. We do not look at Canada. My business partner and the CEO of the company, he is Canadian. But we don't look at the Canadian market. I don't understand it. I can't answer your questions about it, or really any of the other markets. We specialize and niche here in single family residences in certain markets in the United States of America. So sorry. Okay. So wage growth, unemployment, job growth, education levels, right? We look at education levels based on the combined percentage of population with undergrad and graduate degrees. Why? Good education probably means good job numbers, probably means good wage growth, probably means strong market. And if we also are looking at education, even recent graduates and recent degrees, we find that a lot of people nowadays are not interested in buying, they're interested in renting. I don't know why that is. There's a ton. We have seen rental demand increase by leaps and bounds during the pandemic. We did not anticipate that. But holy cow, it's been crazy. People are flooding out of major metropolitan areas, really expensive markets that are not very landlord friendly, and they're flooding to suburban areas where there's single family residences, where there's yards and air, and you're not, sharing an HVAC type, or elevators with thousands of people in major metropolitan cities. And we're just, for some reason right now, we're seeing that people would rather rent than buy. I don't know if it's economic uncertainty. I don't know what it is. But we find with education, a lot of people that are graduating, they're not looking right away to go and buy a home, maybe because they don't know if there's going to be upward motion in their job or whatever. We're seeing that they are just more desirous to rent. So we look at that stuff because that helps inform the decision of which market we want to go to and which market we want to look at. We look at population growth. We look at the population growth, not just of this year or last year. We look at the history of population growth because we're trying to analyze trends. Okay, if we can analyze, and all of this information, you get a good researcher. We've got some excellent researchers, PhD type researchers that help us do this stuff, because I'm not a great researcher. I mean, I did it in college, but it's not my forte. So we go and find really great information and really good researchers that help to inform the decision. Again, we do all of this so you don't have to. Not saying you need to come work with us, but you ought to work with a company that is doing all of this. Not that's just saying, well, it looks like there's a good opportunity to make money over here for us as a company. Let's tell everybody that's where they should buy. It should be more mathematical and more intentional than that. That's just my opinion. Do with that what you will. But anyway, so we're looking at population growth. We're looking at the median home price. And we're looking at the history of the median home price. We're looking at things like cost of entry-level home by state, because that's important, right? We're not going to go and help our clients invest in California or in some of these expensive West Coast states, or even in expensive neighborhoods, because there's more risk associated with that. These really expensive homes, they demand jumbo loans, or it's very difficult to get investment financing. And if you do, you're having to put so much down, and what it rents for just doesn't make sense from a cash flow standpoint, because that's one of the things that we're really focused on. And not to mention, if you go and do expensive markets and expensive real estate, you're shrinking drastically your pool of potential buyers in the future. Okay. One of the things that why we focus on single family residences is it's the most liquid real estate out there. If you go, it's not that multifamily is bad. It's not that duplexes are bad. People love that from a cash flow standpoint, but you shrink your pool of potential buyers in the future. You constrict it quite a bit, because now you as an investor are selling to somebody else that's an investor, right? And so when we do single family residences in strong neighborhoods that are largely owner occupied, if real estate can be liquid, that's how we're as liquid as possible. Okay. So that's why we look at some of this stuff like entry level home price by state. We look at the 3-year estimated price appreciation, but we also look at the historic price appreciation for the last 3 years. So we look at the 3 years coming, we look at what the last 3 years have been, and we draw some conclusions from that. Appreciation for us is important, but it's not the only thing. We are not going to markets where appreciation is the only game in town. One of the things we love about real estate is real estate gives us the ability to be able to take advantage of multiple profit centers all at once. I think this is probably why Kendall loves real estate. It's not just cash flow. It's cash flow and appreciation and tax benefits and hedging inflation. There's all of this stuff where real estate's one of those things where you could put money into real estate and you could refinance that money out of real estate sometime in the future, and you keep the asset even though you've refinanced your down payment out, and now you've taken that down payment and bought another one. So now you're effectively owning an asset that you don't have any of your dollars in, that somebody else is paying for you and paying down your mortgage for you and paying you extra for the privilege of living in your home, because they're paying you more in rent than what you have to pay to own and finance that home. So now that's real no money real estate. Okay. A lot of people talk about no money real estate like you have to go find a friend, or you got to go find financing, and you're going to go do a flip, and you're going to get some hard money, and you don't have to put much up for it, but you're going to have to pay a lot for it. Not that that's a bad thing. That's the no money real estate most people talk about. And it sounds awesome because it's really catchy. You find a YouTube video that says no money down real estate. Everybody goes, I'm in, let's do it. But they don't talk about the risks and the inherent difficulty of doing that kind of real estate if you're not an expert. But real no money real estate is have assets, invest with financing in a market that's going to appreciate in cash flow, then pull that money back out and go buy another property. Now you're talking real no money real estate. Okay. Hopefully I'm not going too fast and that's making sense, but it's just one of those things I get really passionate about, because I've seen so many people lose their shirt with no money real estate because they thought there was no risk. It's quite the opposite. Okay, off the soapbox. We look at new construction based on housing starts. We look at the average age of homes, but we look at the percentage of homes that are built after 1990 and subtract the percent of homes that are built before 1960. That gives us a really good feel for, is it a growing market? Is it an emerging market? Is it an old ancient market? Is it an aging market? We want to know all those things because that indicates the kind of real estate, the kind of neighborhoods, the kind of property, the kinds of repairs that we may be looking at both now and in the future. Okay. We look at the average age of the population, right? That can draw some conclusions for us. The other things that we do, we look at weather conditions, okay, based on stuff like the most nice days per year, the number of days per year with moderately warm temperatures, at least partial sunshine, light breeze, low humidity, no precipitation. We're in markets that are fairly mild climates. Where they may get some snow, they may get some rain, but it's not the extremes, right? Because the extremes can cause some problems. So we like to be in relatively mild. Now, this doesn't mean California mild, right? But you'll see with some of the markets that we're in, you'll get a feel for that here in just a bit. We also look at extreme weather, right? we grab that from a number of places, and we're deducting scores for hurricanes and tornadoes and excessive wind and snowfall and rainfall and humidity and cold and heat and all of these things. We're using that to weight and help us decide which markets we want to look at in conjunction with all these other scores, right? That's why we weight and score all of these items, because then from there we shake loose the 3 or 4 or 5 markets that we really like based on the initial batch of research in phase 1. Okay. We also look at property tax rates. Kendall was talking about taxes. You know, the property tax of the main county for each metro area is important to know. It will affect cash flow. It is something to consider. Now, just because there might be higher taxes in one market over another market, it doesn't necessarily mean that we're not going to go and invest in that market. But it's just something to consider, right? And just the overall tax situation in any given market is something that we want to take a look at, right? You know, we put on here that you know, Indianapolis, we know their tax rate doubles for rental properties, and it goes up in year 2 over year 1. I mean, that's one of those things we know. We know that in Tennessee, there's lower taxes that stay consistent. We know in Texas, there's higher taxes. In Florida, there's higher taxes, but there's no state income tax. So we're kind of looking at all of that, right? Okay. A couple other things. Income tax. What are the state income tax rates? We give the top score to states that don't have any income taxes. But, you know, we want to also know stuff like, is tax filing required for rental income for out-of-state owners? Those are things that we want to know. I'm not the expert on that. Protect Wealth has a billion people that could tell you a lot more about that than I could. They work with the real experts when it comes to tax. So I hope you're working with Protect Wealth and with their experts on the tax side. And I hope you're showing up to these webinars and showing up to the live events, because they are the best. Protect Wealth, Kendall, Don, you guys are the best I've ever seen, with the longest track record and the most success of helping people mitigate and understand their overall asset protection plan and the tax liabilities that they have. You guys are truly amazing, which is why it's such an honor to be with you. So folks, if you know, we're talking about real estate, but if you're concerned about taxes and you're concerned about really planning the right way, there is not a better place in the country to go to than these guys here at Protect Wealth. I think you know that already, but I just wanted to add my 2 cents there. Really, truly exceptional. So some of the other things that we're looking at, right? Landlord friendliness. We were in New York, oh gosh, right before the pandemic. And we've got a lot of clients in New York. We sponsor a major national radio show. It's the biggest radio program in the nation. And one of the co-hosts of that is based in New York, and we were visiting him. He's also a client of ours. And so we were visiting him, and we visited another one of our clients in New York who owns the Manhattan RIA, the Real Estate Investors Association there of New York and in Manhattan. And she told us that at that time that New York State, or maybe it was Manhattan, I'm not sure who it was that passed it. Somebody passed this law that said, if your tenant cannot pay rent, you cannot kick them out. This was before the eviction moratorium, guys. This is normal for us now, right? The eviction moratorium just ended. The Biden administration just finally sunsetted that thing that the Trump administration put into place just over this last weekend. Some states still have some eviction moratorium, but in New York, there was an eviction moratorium before that was a part of the lexicon of all of us during COVID. And what they said is, you can't kick somebody out of your property unless they find a suitable place to live in replacement. So if you don't have to kick somebody out of your property, and if they don't have to really go find a suitable place because they're allowed to stay as long as they want, how likely are you to be able to evict them and get somebody in there that's going to pay rent? So landlord friendliness is critically important, right? Landlord rights by state, eviction process, all of those things are really, really important, right? The eviction requirements. We also look by market at what are the rental vacancy rates by market and by city and by zip code. What is the 3-year estimated rent increase? What are the rent rates? What are some of the best states for business? We look at the, number 29 here, states that are friendly to small business and entrepreneurs. We look at property insurance costs, because that varies by market and you need to know it before you get into it. We also look at airports that are rated by passenger volume. We look at the freeway system, and we combine scores from a bunch of studies that rate cost of ownership and maintenance of vehicles and traffic and infrastructure and safety and access to vehicles and maintenance and facilities and fatalities and pavement and congestion and how much people spend to travel and, tolls. And I mean, all of the stuff that goes into it. In addition, we look at other things like effective mass transit. We look at HOA, right? What rated by the percent of states' population that live with the HOA. If there's a lot of people in an HOA, it's not that HOAs are bad, by the way. HOAs can be nice because you've got an extra set of eyes looking at your property, but there also could be some downsides to HOA. It can eat into the cash flow, and it can cause some problems when you're owning rental real estate where you don't live if you don't have a good property manager. So we just look at it and we weight it, right? And the 35th thing of all these 35 criteria is the foreign entity registration and LLC requirement rated by cost of registration of LLC in the state, okay? Whew, it's a lot of stuff, right? So I don't share all that with you to sort of burden you and to frustrate you and to make you go, holy cow, this is a lot. I'm just saying, hey, if you're really going to do this, you ought to be working with somebody that is considering all these things, because all of these things matter. Real estate is not so simple as I heard there's a good price over there, or I think that market's going to do well. You can get yourself into a lot of trouble if that's the case, okay? So what I wanted to kind of conclude with tonight, and I'm going to show you a couple numbers based on the markets that we're in, but based on all of the research we did, here's the top 10 investment markets that we're kind of seeing in 2021 and beyond. Orlando, Oklahoma City, Memphis, Indianapolis, Charlotte, Atlanta, Cheyenne, Idaho Falls, Austin, and Jacksonville. And we currently help our clients invest in 5 of these markets, those top 5. We help our clients invest very successfully in Orlando and Central Florida, in Oklahoma City, Oklahoma, in Memphis, Tennessee, in Indianapolis, Indiana, and in Charlotte, North Carolina. Now, I thought what would be kind of cool too is if I showed you just some numbers and some basics on these markets. So I put this little table together for you guys just to give you an idea of at the end of the day, after all of that research and all of that criteria and all of that scientific and mathematical approach and all of the score weighting and deciding which markets we're going to, what is actually happening for our clients in these markets in the price range of homes that we're looking for with the right sets of conditions and in the right types of neighborhoods that are attracting the right kinds of tenants and the right types of property managers. This is what we're seeing in real time. This is the track record that our clients have established over the last 15 years. So if you look at the average cash on cash return by market, you can see that Memphis is a higher cash on cash return. So is Oklahoma City, Indianapolis, Charlotte, North Carolina, and Orlando are lower on the cash on cash return. Now, again, the way we're calculating the cash on cash return, and if you guys, by the way, if you want to, let me see if I have this pulled up. Let me see here. Let me just get out of this. I'm gonna go. Okay, this is our website. You're still seeing this, right, Kendall? You're seeing my website?
Yeah, it looks really good.
Okay, awesome. So just so you guys know, if you click on this link right here, see the properties, you could go in and you could look at the actual numbers on a bunch of properties. Now, right now, when you click on see the properties, what you're gonna see properties in all of our markets. These are property examples. These are properties that here I'll click on it and show you guys.
Yeah, I think show them around because I love to poke around. I've done a lot of poking on your website, Kevin.
Awesome.
I mean, it's full disclosure, full transparency. I'm not aware of any other company that does that. Are you?
Not personally. I am aware that my Wi-Fi apparently is ridiculously slow. Look at this. Look at this thing is loading. It took about 100 years to get this page. I promise it'll be better at home, guys. So I don't know anybody else that does this, that really shows their numbers, that shows you how they make money. Just so you guys, I told you guys right off the bat, the way we make money is we make a flat fee per property. We charge $4,995, goes on the closing documents as a separate buyer paid commission. I'll show you in a second. We include that as part of your total out-of-pocket expenses that we're generating returns off of. And we also own a mortgage company. So if we do the mortgage for you, we make a little bit there. We also own a PNC insurance company. So if we do the landlord policy or a liability policy, we make money for you there. So what you're seeing here is really kind of what I did right here, but I'll just kind of show you around. You know, we put the properties on a spectrum of cash flow to appreciation. And if I'm not looking at the camera, I apologize. It's because I'm looking at the screen that my web browser is open on. So if you're seeing the side of my face, it's probably not my good side because I don't have a good side, but yeah, I apologize.
Good side, buddy.
So if you look at this, you know, Memphis is on the higher cash flow. Orlando's on the higher appreciation. And you look at the average returns, cash on cash, annualized ROI, projected appreciation, monthly cash flow, the average expenses, about how much it costs to get into these properties, right? Average purchase price, average total out of pocket. Now, our average total out of pocket, you can see, is around 65,000. That's because we generally do 25% down purchases. The reason for that is you get a better interest rate, you get better cash flow. 20% down purchases are available. It is something that is out there, but a lot of times the numbers look better at 25%. You'll see some 25% examples here. Doesn't mean you can't do 20%, but 20% is the minimum. And then we also do things like market highlights, right? Like what is the projected rent increase? What is the projected home value increase? What is the economy relying on? We kind of give all this to you. And then when you scroll down, you can see a variety of properties, okay? And what you'll do is you can look at a handful of properties. These are all recently transacted properties by our clients. We do not create a red ocean or a meat market on our site. We will not show you properties that are available for sale. So you can't go on here and say, Kev, I like this one. I want to buy it because somebody already bought it. Okay. These are real properties that our clients really did purchase. And I'll kind of give you an example here, right? So if we look at like this property right here, okay, you click on it, it's going to pull up a larger picture. This is in Cordova, Tennessee, $245,000 purchase price, 4-bed, 2-bath. Year built 2002, 1,700 square feet, projected rent 1,600. That's what got collected. The average monthly net cash flow with 25% down, 423 a month, cash on cash, 7%, profit on sale if you were to sell it after 5 years. And then what you'll see is when you click this button that says 25% down payment, you see a full number breakdown. Okay, I'll zoom this a little bit. So, and this is, you could go and look at this on any of these properties, okay? Gives you the example, gives you a picture. It shows you this is 25% down. It shows you what we're estimating the interest rate at. By the way, 25% down is a lower interest rate than 3.625. We try to estimate high when we're generating these pro formas. This is what our clients see before they put an offer on a property. But we show you closing costs, interest rate, property management fee, vacancy and repairs, the projected appreciation based on all that data and research that I showed you earlier, the annual rent increase, closing costs on the future sale. We even look at that and say, look, let's assume you sell it in 5-10 years. You're going to have to pay 6% real estate agent commissions, and then you're probably going to have to put some money into the property to make sure it's ready to sell. So we say closing costs on future sale, let's calculate it at 7.5% to keep the numbers as conservative as possible. Then we show you a breakdown, what the down payment is, the closing costs, the rehab expenses. This is what we charge on a per property basis. Then we show you what your total out-of-pocket expenses are. We show you the breakdown of monthly income. And then we say, look, if we were to break it all down and say in year one, you're collecting this much in rent, you're paying this much in taxes, this much of in insurance, there's no HOA, this is how much you're paying in property management, this is your net operating income. You subtract out the debt service, you divide that by 12, and this is your net income on that property on a monthly basis. And that gives you a 6 cap, that gives you a 649 cash on cash. This is coming from your total net income divided against not the purchase price, but against your total out of pocket. By the way, that is something you got to look for. If you're working with companies, they will largely show you returns based on the purchase price or based on the down payment, but not based on your actual expenses. Okay. And that's a really critical thing because there's a lot of people that love to make their numbers look good. We just know the numbers look good as they are. We don't have to hide anything. This just gives you kind of the way that works. And it'll show you, if you sold, if we're anticipating what we're anticipating for appreciation, and this shows you the annual appreciation growth. If you were to sell in year 5, you'd walk away with $65,000 of profit. And this is based on all of these numbers and all of these assumptions and all of this stuff, right? And then we just kind of average it out. So you can take a look at these numbers. The way that we're creating this 5-year annualized return is we're taking a look at your total profit after 5 years. We're dividing that against your total out-of-pocket expenses, and then we're dividing that by the amount of years that you owned and then that gives us our annualized return. That's just how we do our numbers, So I just show you guys that just to, I just want you to kind of see how this works. You can click around on here, look at a variety of different options. Probably this week we'll have our 20% down pro formas and our cash pro formas. We've been going through a website redesign since we just opened Oklahoma City. We've had to put a bunch of stuff on here. So that's why I don't have all the numbers up here yet. But anyway, Kendall, do you have something?
Yeah, I'm gonna say, so the part I love right there where it says see the results, beautiful. That to me really blew my mind. So a lot of our people on the call are real estate investors already. So you can go back, how many years? Like 6, 7, 8 years and
back to 2013.
Dude, every transaction right there in front of you. So those of you who are real estate investors already, you want to go do the numbers, it's all right there. I love this.
So yeah, we post every transaction that we do in a report. We'll tell you by acquisition sales price, what we did by market. So last year we did 55 million with our clients in real estate. And then we'll show you things like what the average amount of equity created was when our clients did sell their property. We'll show you what the average purchase price was to our client, the average square footage, the average price per square foot. We'll show you things like the average time that it took to get leased, how many homes that we got leased. You guys, we're not a huge company. We got 23 W-2 employees. We try to average 40 to 50 purchase transactions a month. That's what we do. And that's, you could go back and you can look at these annual reports from all the way back in 2013, every single transaction we do. We'll even show you, by the way, I'll just show, we don't do full addresses for privacy, but when you scroll down, you can look by property, where it was located, what the purchase price was. And then, you've got information like year built, square feet, what the average price per square foot was. We just put this is all the homes that we did. Okay.
Nothing hidden, all transparent. This is huge. I think, sorry for me, sorry to interrupt you, Kevin, but I tell you honestly, for a lot of you investors out there, if you want to poke around and run numbers, and know a lot of you do that with me on the phone, taxes and our tax pros do run a lot of numbers with you. So I know you're numbers savvy, but if you want to poke around, there's nothing hidden. It's all there.
It's all there for you. And, you could do other things like check us out on Better Business Bureau and look at our Google reviews and stuff too. But this is where the rubber meets the road. You can look at actual properties, you can look at actual results, and you can learn all about us and who we are. It's not so important who we are as much as how we serve you. That's what we try to focus on. We've got all kinds of links to our podcast and our social media and all kinds of stuff that you guys can just kind of take a look at here. But what I wanted to do is just kind of give you really an overview and say, okay, look, this is who we are. This is how we get here. This is the real estate that we do. These are the numbers that we're seeing based on all that research and all that criteria. And my only hope for you is that if you guys are thinking, hey, this is great information. I love it. I love the work you guys have done. I love the extensive nature in which you selected your markets, but I don't personally want to go and do that. My only ask is just go do research on our company. You could listen to our podcast. You could go click around the website like we just showed you. Spend some time on the site. I think you'll find a lot of awesome stuff. And Kendall, we should probably let them know this too, that if they go to protectwealth.com/DFY, we would love to have you sign up to get a phone call with us. Really all you do is you enter your information. We'll send you some cool stuff, but I'll jump on the phone with you, or one of my partners will jump on the phone with you, and we'll just answer your questions. And we'll talk about what real estate with us could look like for you. But again, I don't expect you to work with us. I just wanted you to have this information, to have this criteria, and to know a little bit about what we go through to get to all of those results, to get to this. There's some videos and stuff on here that you guys can look at, but these results, I wanted you to know how we get here. These properties, I wanted you to know why we've selected those markets, because regardless of whether or not you work with a company like ours, here's what I can tell you is you should be in real estate. In fact, I always say that everybody's already in real estate. You're either on the side of real estate that's making you money or on the side of real estate that's making someone else money. And if you're in real estate for the long run, it's going to serve you well, assuming you're buying the right property in the right market and you're making the kind of common sense, not emotional decisions that you need and that you're giving it the time that it needs. That's critically important to us. We are not home run hitters where we're trying to look and get a quick buck. That's not what we do. Simple and conservative single-family residential real estate is what we found to be the most conservative, the most successful, the most liquid, the safest way to grow your wealth in real estate over time. And that's really what we specialize in. And so if there's some way we can serve you guys, that's awesome, right? The best thing for you to do would be to go to protectwealth.com/DFY. That way we know that you are part of the Protect Wealth family, because we have a different conversation with you. If you just go to the website, we may not know, where you came from. I mean, you could always tell us, I guess, but when we know that you're part of the Protect Wealth family, we can have a different conversation. We know what your background is a little bit. We know that you have somebody like Kendall and Dawn in your corner, and that changes the conversation. And so if we can serve you, awesome. And if not, I just hope that this webinar, which I think is probably going to be recorded, I hope that this information is beneficial and helpful. And I just hope that it serves you guys well in your real estate adventures, whatever those may be. And I hope that was, Kendall, was that, I mean, I went fast. Hopefully that was enough good meat and potatoes content that helped everybody kind of see what we're seeing and really what we're doing. This is all we do. And so we spend all day with this stuff.
Wow. Thank you so much, Kevin. No, I love it. And the thing is, I was going to mention too, so if they go to protectwealth.com/DFY, done for you, that link will then get you some bonuses too. So there is some bonuses. I know Kevin said, I've seen a lot of those. It's kind of cool information. So there are bonuses by going that way. So we encourage you to do that. And then your team, Kevin, so I've kind of gone through the process too. They're awesome at getting back to you and getting me info. I'm getting info all the time from you guys, and I'd love to poke through it. So good stuff. Thank you so much for that.
Awesome.
I did put it on the chat screen, by the way. It is clickable, protectwealth.com/DFY.
Awesome. Hey, I know there's a bunch of questions. Should I go in and kind of take a look?
Yeah, please jump on in. Yeah, great.
So we had Rhett say, is 4 to 8% cash on cash returns? Is that net after deducting all the expenses? Yeah. And you could go on to the website and you can kind of look through and run those numbers and run them yourself. Also ask, what class properties are these? Like BB plus. So we're not doing the super high end stuff. We're not doing the low end stuff. We found that the niche that works really well, especially for most of our busy clients, is that, that BB plus kind of range. That's where we like to be. Jack said, you said you're not a turnkey company. What's your business then? Market research company. So the reason I say we're not a turnkey company is we're not a traditional turnkey company, meaning most turnkey companies will wrap up a property, have it already leased out, and hand it to you and say, there you go. They wash their hands of you and you got to figure it out on your own. Our process is we help you do research. We then assign you an account executive. We get you all the way pre-approved. We then have you shop individually with our agents in the field. They will hand select, pick properties for you that are on the open market. You're competing on the open market, but not against additional done-for-you real estate clients. It's hand-picked, customized, all the way top to bottom. From there, our property managers go in, do the rehab, and then lease out the property. You actually get a say on who you're leasing the property out to, not just buying a property that's already got a tenant that you may or may not like. And our property managers are exceptional. And then beyond that, once you get that property rented out, we work with you year in and year out. In fact, every year around the anniversary of the purchase of your property, we put together a full property and market review where we will pull up numbers on your property. We'll show you how it's performing, what it's doing, what numbers would be like on a refinance or on a sale or whatever. And then we show you what's happening in the market. We show you the data that we're doing. We show you the research from our data sources so you can see where the market is trending, what's happening, so that you can make informed decisions year in and year out. We don't charge for that. We made our money when you transacted a property. For us, that means your family. We will work with you forever. There's an incentive for us because if we can help you buy more real estate in the future because the experience is so awesome, 75% of our transactions every month come from existing clients and referrals. So we continue to work with you long after you do that purchase, as opposed to washing our hands of you and saying, hey, you got a property, call me if you want another one. We are here for you. That is how we are very different than a traditional turnkey company.
Okay, so I'll jump in on that one too a little bit too. So a lot of them are real estate investors, and they've gone the rounds already with their own real estate. So find a property that's a good deal. You can't find foreclosures right now. You can't find short sales, bank-owned properties. They don't exist. The market's too hot, right? They're hard to find. So a lot of them have done that work in the past. They've found some distressed properties and fix them up. And I know, Kevin, you are amazing with the hammer. In order to buy real estate with you guys, you have to be good at construction. No, right? Yep. That's the thing. A lot of our people have been to the ringers, and they are good at construction. They are good at finding properties. But at the end of the day, honestly, a lot of them are getting the same or worse returns than what you can do done for you.
Yeah, so I put it this way. So whenever there's a lot of things I could do on my own at my house, but I don't because I'm really busy. And I could swing a hammer all day, but I'm going to take time away from my kids, time away from my family, doing other things or family activities, time away from the office, time away from serving my clients. And if I'm doing that, there's a cost to that. And so while I could do that stuff on my own, I would rather pay somebody who's better at it than I am, and then keep my time as mine to dedicate to the things that I am good at, or that I'm better at, or that I'm best at, and the things that matter most to me. And so that's why we do it that way. It should just be a simple, straightforward solution for busy people that don't want to do all that stuff. You know, we have a lot of clients who've done a lot of real estate, and they get to the point where they're like, "Hey, I'm tired." Yeah. You know, and a lot of people do real estate in their backyard. They're doing the property management, or whether they live by the home or not. So they say, "Look, I'm ready to just be done." And when they do the numbers, they're doing as well or better with our properties and our system than they were if they're doing it on their own, and they're saving crazy amounts of time and effort. And so that's kind of some of the benefit for people if you are a real estate investor, if you've kind of been through it.
Away from them going out and doing all the work on the property, finding the property, and they find they have more time to find more deals or do more deals. And I love what you told me, a few stories you've worked with some of our students where they had a bunch of properties worth, I don't know, millions of dollars in California, right? That's every house in California. And then they basically weren't cash flowing. They can take that and buy properties elsewhere and cash flow like crazy for the first time in
thousands of dollars a month versus barely covering their mortgage just by, you know, I mean, that's, you know, financial principle 101, right? Take resources of low yield and move them to areas of high yield, right? And that's all we're doing, right? The dollars stay in real estate, but you might be able to put those to work in a different market and in a different way that's far more effective. And that's so we can help people in that way too. Because if you're not an expert in Oklahoma City or Florida or, you know, Memphis or, you know, wherever the markets are where we're currently transacting real estate with our clients, let us be the experts for you, but you own the real estate 100%. You make 100% of the cash flow, 100% of the tax benefits. You're the only one on title. We do not share in that with you. You own it. We're just the team that does all the heavy lifting for you. That's kind of what we do.
Love it.
Cool. Yeah. Okay. Sergio, I like Sergio's comment. Well, it's not, I mean, it's more a comment than a question. He says, "You are the best." I'm pretty sure he's talking about you, Kendall.
No, it's you. Definitely you.
All right. I'll take it. I'll take it. We have Josh, who said he just read that the CDC issued a new eviction moratorium today that covers 90% of the US. You know what? I have been in appointments all day, so I'm not going to pretend that I've heard about that or know about that. That very well may be the case. Now, one of the things that is important to point out with an eviction moratorium, if you buy the right real estate in the right market that attracts the right tenant. So for example, we saw that like nationwide, there was like 40 something percent. By the way, our podcast next week, we are going to be talking about the eviction moratorium. It comes out on Monday or Tuesday next week. But what we saw is 40+% of people were not paying, you know, their rent. They couldn't get evicted. Among our clients, it was less than 8% because it was a different type of property and a different type of person who had a different kind of a job. That's part of why we do the neighborhoods that we do. So it's really critically important. The other thing to consider, if you are jumping into the market today, the moratorium may not really affect you for this reason. It could, but if you're buying a property today, you're going to have a property manager that is looking for, evaluating, looking at a credit check and a background check and calling references of a tenant today who, if they find out that tenant hasn't been paying rent, you probably are not going to win. You're probably not going to give that tenant your property, right? So you're looking at people that are currently employed, that are gainfully employed. And so the moratorium may not have as much of an impact on you if you're buying one of these properties in these states now. Whereas here's the other thing. This is one of the things we talk about on the podcast. Here's a little for your Gee Whiz file. Kendall, there are 418 aid programs available for rental tenant assistance. Wow. There are billions of dollars that the federal government has earmarked so that you can make money as a landlord if your tenant can't pay. Your property manager should be aware of these programs. On the podcast next week, we are actually giving a list of all 418 programs by state, right? So that you can, so I don't have it in front of me right now, or I give it to everybody right here, but maybe I could look it up. I don't know. But anyway, it is available to you. If you Googled it, you could find it. So that's another thing. You work with property managers that are aware of the federal aid programs, and that can make a massive difference. So even if there is an eviction moratorium, there's billions of dollars that have not been released by states and by the government that are earmarked for aid. But if you don't go and find them, it's just sitting there, right? It's so just, that's for everybody's gee whiz file. You ought to look into it.
Well, that's another good point. I think going back to, I've self-managed properties. I currently do, and I have several properties that I do not self-manage out of state. And so the difference is, a lot of you who are self-managers, really hands-on, a lot of you love to just be in every detail. That's taking time and money away from you long-term, for sure. It really is a major difference done for you. I think at the end of the day, brings back that time and brings back the dollar for you in your pocket to go and find more properties. And that is true. We found, at least with us personally too.
Yeah, no, that's great. I mean, it's great feedback. Miriam said, hello, do you accept funds from a Roth IRA account to invest in real estate? Of course. Then if it's self-directed, right? So it's got to be a self-directed IRA. You can buy real estate with self-directed IRA. Kendall and Dawn and their team have way more information on that, but we've got a lot of resources on our website as well. If at the bottom, I didn't even show you, but at the bottom of our site, we have links to 1031 exchange information, self-directed IRA information, all kinds of good stuff. And we refer our clients to Protect Wealth and to Kendall and Dawn if they're looking for asset protection and LLC stuff, because they're the best out there. But if it's a self-directed IRA, then yes, there are limitations. You usually have to buy cash. It's very hard to buy with a non-recourse loan. A lot of times those numbers just plain don't make sense. As good as it sounds to be able to finance inside of a self-directed IRA, you got to look at the numbers. But then there's other ways that you can partner IRAs and things like that to be able to take down real estate that's really effective. So
we do a lot of that. We do a lot of partnering, and it can get tricky, but you can do it. So if you have 50% of the cash in an IRA, total tax-free, great strategy, guys. 50% in an IRA and 50% funding or cash or otherwise, there's ways to partner with your IRA to get that done.
Yep, super cool. Joseph just said New Jersey's difficult also. Carl, what's included in your cash flow line? So I think I probably went through that, but if you guys go look at that pro forma or those pro formas online, you'll see that we're saying the cash flow, we're showing you we're showing you gross income, subtracting out everything, and then showing you net income. And so should all be in there. Anonymous attendee, what a cool name. Anonymous. Oh, I got to tell you, we had the coolest name of somebody buy real estate today. I'm not going to tell you what their name is, but it basically was something along the lines of, but I'm going to change it a little bit. It was like Anita, good investment property, right? It was almost the equivalent of that, but it was like Anita, good investment property. Like it was like that, but not exactly that, because I want to protect her property. It was so cool. I was like, that's the best real estate investor name ever. So anonymous attendee also, who would have thought? What a cool name. Kidding. Do you look at foreclosure? We did in the past. Right now, there's just not as many foreclosures as one might think. Maybe that comes around in the future. Foreclosures bring with them a whole nother slew of challenges and difficulties. Not that it's bad, but it also doesn't always mean that it's good. So just kind of throwing that out there. Do you do property management too, or do you refer partner management companies? Our property managers, they are our property managers, but we do not own them. But 95+% of all the doors that they manage are done for you real estate clients. So I won't go into a ton of why that works successfully, but it works better than us owning the property management. There's increased accountability and better communication by doing it that way. So are you selling me these properties, or do you help me find these properties and charge a consulting fee? I'm still not sure what your business model is. So I think I kind of went through that, but really our job is to help you create a strategy. And then when you decide you want to go and do investment real estate, we get you pre-approved. We then hook you up with an account executive who will help you select the right market to invest in, who will then introduce you to our teams on the ground, who will then find you properties that are handpicked, custom selected for you. And then we organize, oversee that entire process so that you're doing the heavy lifting, you're not. And for that, we charge what we call a team's fee. Okay, that's kind of how it works. And if you go to the website, you'll see a bunch of stuff and videos and kind of that describe that. And then are you just in the East Coast, anything near the West Coast? He's interested in Arizona. We used to do a lot of real estate in Arizona. Right now, Arizona, it's expensive, but it doesn't cash flow. The cash flow hasn't kept up. We love Arizona. We've done a ton there. We are not currently acquiring there. Non-recourse loans, Carl wanted to know about. We do not do non-recourse loans. I touched on that. You got to find a good non-recourse lender with good terms in order for it to really work. But most of what we're doing is conventional mortgages, 30-year fixed type mortgages. Valerie, how can we research a company? I think we showed you that. Are the properties brought from the MLS or other investors? We kind of talked to that. It's majority MLS, and it's mostly folks that are selling the property to an end user, which changes the dynamic of the interaction, which we find is very successful for our clients. And then we've got Alana, is DFY connecting investors with property managers? Yes. Is DFY helping to resolve issues down the road, such as taxes, property manager? Absolutely. That's what we are here for. That's why we do not leave you to your own devices. We are here for the long haul with you. Does cash flow that's in underwriting take into account maintenance expenses that happen down the road? Yes, it does. If you look at our real estate pro forma, starting in year 2, we start to take into account vacancy and repairs, because the repairs are done in year 1. We don't put vacancy and repairs in our year 1 numbers, but every year after that, we are including those because we have to take that into consideration. So that's factored into the numbers. What's the average time of up and down market value? Real estate moves a lot slower than other things. So that's kind of hard to say, but you look at 2008, it probably took 2008, 2009, maybe 3-4 years before it came back to where it was before the crash. If you would have sold during that time when it collapsed, you would have been in trouble. But if you just hung on to it, you'd be in pretty good shape. Property management, we addressed that. Thank you. Can you send out the link for the podcast? If you go to start by going to protectwealth.com/DFY. You will be on the list that will, when you go do that, we'll make sure that you're notified of podcast episodes when they drop, or you just go to iTunes, Apple Podcasts, Spotify, Stitcher, Google Podcasts, and go look up Replace Your Income and hit subscribe or follow, and then you'll be good to go. Valerie, 1031 exchange. We do a ton of 1031 exchanges with our clients. We are very well versed with those. We work with great 1031 exchange companies. And there's information about that on the website too, at the bottom of the page. What's your typical move out repairs? That expense is not accounted for. Yes, it is. If you look at the pro forma, remember I said that we say 7.5% closing costs upon the sale of the property in the future. That's taking into account real estate commissions, which are probably going to be reduced anyway, plus some expenses to get the repairs done. So you got to factor in and figure a few thousand repairs. Plus there was vacancy and repairs that you've done along the way, which are also factored in to the numbers on a monthly and annual basis. So it is all in there for sure. Average monthly management fee, Paulette, varies by market. Memphis, 8%. Orlando, they do a flat fee for the first 2 years, then 8%. The flat fee ends up being closer to like 6%, but you pay it all up front and then you get the rest of the cash flow. It's kind of cool. Indianapolis, 10%, Oklahoma, 8%, Charlotte, 8%. Okay. So there's your management fee. And T says, okay, thanks. Great webinar. Well, T, thank you for being here with us. So I think we got them all.
Yeah, so fun. I love it, Kevin. So we've got experience in different markets too. And I love your analysis. Even, a lot of our students and different things have done at different properties. And we found, gosh, you're right about your level of markets. It's so interesting because just going through some of that with some of our students over the years, talking about their investments and their asset protection and tax strategies. Okay, let's buy the lowest cost property we can find. There's a cost to that, like you said. And you're kind of going more here. And that's interesting because it does cash flow better. And eventually everybody seems to get there anyway too.
It does. Well, I always think of it like this, if you're going to travel from A to B, you could either get a 1989 Toyota Tercel, or you could get a 2013 Toyota Camry, or you could get a 2021 Toyota Camry, or you could go get a 2022 Lexus. All of them are made by the same company and they're going to get you from A to B. But which one is going to be the most pleasant without having to pay the most money? You get the Toyota Tercel, it depending on where you're going and how long you're going to be driving it, that may not be a good idea because of the amount of expense and ongoing repairs, maintenance, and difficulty. You get the slightly used Toyota Camry, going to pay less, but it's probably going to be a little bit more dependable. You get the new Camry, you're paying a little bit more, and now you have even more dependability for the longer run, but you're not paying as much as buying the Lexus. We're the 2021 Toyota Camry. That's how we look at our real estate.
I love that. I love that. A great analogy right there. That's kind of fun. Yeah, because we looked at properties, it depends on, a lot of people look at the neighborhoods. That's a big deal. Yes. I love you factor that in there. The neighborhoods do play, schools, that sort of thing. And if you have high turnover, that's going to cost you every time. You want low turnover. I love it.
Well, yeah. And so this is a critical piece, right? So neighborhoods, not just a good neighborhood, not just a good school, but primarily owner occupied neighborhood, because that increases the sort of pride of ownership, which has an impact on those that are renting in the neighborhood. It really does make a big difference. And in addition, if you're in the right neighborhood and doing the right property, you're attracting the right kind of tenant, which means you've got a property manager that's going to be serving you and serving the tenant. A lot of people forget, if you use a bad property manager, a lot of people think a bad property manager is one that doesn't send you your checks or one that doesn't communicate with you. Yes, but also a bad property manager is someone that is not responsive and bending over backwards to serve your tenant. Because if they don't serve your tenant, you're the bad guy. They're moving out of your home because your property manager didn't serve the tenant. So there's a balance there. And there's the property management's where the rubber meets the road. That's why we work with some of the best in the country. And almost all the homes that they manage are done for you real estate clients. There's an incredible relationship that exists there.
So last question, I think we get a lot. Stocks versus real estate. Which one?
So, I'm not going to tell you to do one over the other. I'll tell you what I do.
Both, maybe.
Yeah, maybe. For me, it's primarily real estate, because real estate provides more for me than the stock market will. Both will grow, but one, and here's the way I look at it. If you were to go build up a 401k and IRA, and you spend 30 years to build up a stock portfolio, only for you to start to rip it apart, once you're retired, that's just, because you've got to pull off of it, right? You're now not having money in the market continuing to grow for you because you're having to make withdrawals. You're decreasing the account balance after you've accumulated an account balance and seen the growth with it. Well, that's the equivalent of building your dream home, board by board, brick by brick. And after maybe it takes you 30 years to build your dream home, board by board, brick by brick, you lay it all. And then you start to rip it apart, shingle by shingle, board by board, brick by brick. That wouldn't make sense. Nobody would do that with a piece of real estate. So why do we do it with our financial lives? With physical real estate, you can build that nest egg without depleting the account balance. You let one home grow and appreciate so that it can go do a 1031 exchange and go buy two homes in the future. And you're being able to buy that piece of real estate with not necessarily having to pay for all of it up front. You let the bank take care of 80 or 75% of it. You bring the 20 or 25%. Now you're owning a more expensive asset that's producing at the level of the value of the asset, but you didn't pay for the full asset. And it's cutting you cold, hard, spendable dollars, cash every month instead of depleting the account balance, right? It stays intact and grows while it cuts you cash flow every single month. Plus it's going to hedge inflation because it's a natural hedge against inflation. Plus it's tangible, which means it holds its value, and it's not going to fluctuate or be as volatile as the stock market will. We could wake up tomorrow and your stocks may have tanked 50%. Your real estate will not take 50%. It could tank, but it also is going to recover because there's a tangible nature to real estate that we've proven. I mean, the stock market's always grown over time too, but there's just facets of real estate that I like better. Doesn't mean my opinion's right. That's just the way I look at it. And the other thing is, with real estate, I can hand over a property to my kids, and that property could pay for their life forever. Whereas maybe dividends will, maybe they won't, but they could continue to grow that portfolio. There's additional tax advantages that oftentimes come with real estate that you don't get with certain type of stock investments. So look, do what you will. Yep. We like real estate for all of those reasons, especially simply conservative single family real estate.
Yeah, a lot of them are investors do stock market investing too, but a lot of them take those earnings and they put them into real estate. It's kind of fun.
Makes a ton of sense. Yeah.
Yes, I totally agree. Kevin, this has been fantastic. I learned a ton. Really, really appreciate you sharing that. I feel like that was kind of a lot of the secret sauce behind DFY, and you guys are so transparent. It really makes me feel comfortable, with you guys, and I know a lot of students are too, just because you guys are so transparent. I love it. I can go back to 2013 and see everything from there on. That's amazing to me. I really don't know anything else. Really appreciate your time tonight. Great information. So again, protectwealth.com/DFY. Kevin, you give some great bonuses there. We're happy to help. Any questions too. Kevin, anything else before we close?
No, I would just say, listen, everybody, we live in a crazy world. There's a lot of stuff going on out there. I'll just give you my here's the real secret sauce. This isn't a real estate secret sauce. This is a life secret sauce. Find ways to be thankful for all of it, including the hard things. Whether it's real estate, whether it's stock market, whether it's the guy that cut you off on the freeway, whether it's the lady that cut you in line at the store, whether it's the fact that gas is more expensive than you want to be or not. I guarantee you there's a seed of something to be thankful for inside of all of it, including the frustrations and difficulties. And if we can focus on that and exercise real, live, active gratitude in the midst of even our most difficult trials and circumstances, it changes our brain chemistry, it changes who we are, and it literally shifts our disposition to one of cheery. It's amazing. There's a lot of science that backs it, and it has changed and transformed my life. And to be honest, it's transformed our business, and it's transformed my real estate. We can't always control life as it comes at us, but we always retain the ability to control how we choose to react to life as it's happening. And the same could be said for our investments. The same could be said for our asset plan. And our choices will truly determine our overall destiny. We always say that, Kendall, you and I have a phrase that we love that says, decisions determine destiny. We can make small decisions inside of seemingly insignificant moments of gratitude and joy that shift the trajectory of the very nature of our lives. Just share that with everybody, because I think it's something that we need to know and think about now, maybe more than ever, in a world that feels very divided, in a world that feels very sort of pitted against itself. Listen, we're all humans, and we have a chance to love and respect one another at all times without exception. And that, my friends, is the real secret sauce.
Amen. I love that. Thank you so much. Now that's an abundance mindset, and that is what we're all about. Thank you so much. Love that positivity. Das war's sehr gut. Next time, do it in German, okay?
Understood.
Everybody, thank you for being on the call tonight. Kevin, again, thanks for your time. Make sure to visit Done For You Real Estate, and please let us know if we can help with anything. Everybody have a great night, and thanks for being on.
Thanks, everybody.